So at this event, we talk a lot about venture. And, you know, it's a fun conversation, and since there's so many startup companies, it is nice to kind of be around and to kind of be part of that vision of what are we building and everything else. And at the same time, venture, the primary markets don't exist without secondary markets. You know, there's no place to go very often. The goal is to get a pricing, to get a valuation, and to get liquid. And you know, you learn kind of in exchange kind of 101 that the natural sellers and the natural buyers don't arrive at the exchange at the same moment, which is why all the other participants are important, right? The market makers and the high frequency traders and the arbitrageurs and all those strategies matter, and how they work and function matter. So Srini and Carson and John are here. Srini representing the fund-to-fund side, multi-strategy. Srini's going to help us kind of understand all the different strategies that are out there that are liquid and you can invest in. Carson comes to us from the infrastructure side, because if it sounds complicated, wallets and storage and bookkeeping, that's what Carson does. And John, at the big kahuna in crypto, Grayscale, is going to kind of help us see that history that he brings from Invesco of seeing ETFs grow and what role ETFs play in the marketplace. Unlike a lot of the other panels today, we actually got Srini to bring us a couple of slides, and maybe they can put that up now. Let's do the next one. We'll go back to that. There we go. So I'm going to start with Srini maybe to give us a little context, and then bounce around these guys. But maybe if you could talk a little bit about, you know, first of all, introduce what Newform is doing. And then if you could kind of talk a little bit about how you see the opportunity set in active markets.
So Newform is actually a venture capital fund. And Phil and I, who's in the audience, we represent the liquid strategies. We run a fund of funds that exclusively invests in managers that trade liquid tokens. So we have two share classes. One is directional, so if you want a directional exposure, and it's just beyond Bitcoin and ETH, you know, we have 8 managers and our own direct holdings, you know, that can get you exposure to that. And then we have a market neutral strategy. Given that it's such an early stage ecosystem, it's so nascent, there are tons of mispricings, there are tons of opportunities in that market. So there is a market neutral share class as well. So, I mean, I'll just start off by saying, you know, I don't look at the liquid market as a secondary market at all. Like, I think this is a very unique asset class where you should think about all these liquid tokens, with the exception of maybe Bitcoin, because it's kind of like got its own ethos, it's got its own use cases. Everything else out there is liquid venture, right? Like if you think about blockchain and its fundamental role, it's basically a piece of software that does nothing till the token actually starts to trade, because that's the currency in which you get to basically, you know, pay your transaction fees, and all the, like, you know, service providers effectively earn that as a revenue. So I am here to effectively suggest that, you know, when investors have looked into this ecosystem, and I think it's muscle memory or whatever, an early stage ecosystem, people say, you know what, I want to put money into venture. I don't want to deal with the liquid markets because it's the Wild West, you know, whether it's muscle memory from .com or whatever. So what I'm here, you know, so effectively, like, what I'm trying to talk about is liquid markets effectively are venture capital markets. If you have a long enough time frame that you would allocate to a venture capitalist to exit, liquid markets in that same time frame have the ability to generate extremely attractive returns, with the added benefit of being, you know, able to exit at any time and risk manage your portfolio. So I just basically put up a couple of charts to talk about, the state of the markets. So as I broadly see it, the liquid markets, not the liquid markets, so the overall markets in crypto, you have your, ETFs and closed-end funds, which is, I would say 90% is Bitcoin. That's currently, like as of June of this year, currently stands at about $93 billion. And then you look at the venture capital, like how much venture capitalists have raised since 2017, which were like some of the earliest venture capital firms. That's roughly around 75 billion. And the liquid active managers, the sleeve that basically is really kind of like defining how you, the price discovery, guys who are actually doing research on, which projects actually have merit, which don't, are providing basis for relative value. That's a small $21 billion, ecosystem. And if you basically look at the active fund AUM, the fundamental side is only about 16 billion. The other parts are like market neutral. So why is this important? If you can move to the next slide, please. So our view is, at the current setup, the markets in crypto are upside down. So if you look at equity markets, the size of the venture capital markets relative to the active managers, meaning where the VCs kind of exit into, it's roughly around 1 to 8. And in crypto markets, it's the opposite. Now, why does that matter? Majority of the tokens, majority of the venture capital investments exit as tokens. There's really just been one exit as, an IPO, which was an amazing one, Coinbase. And I suspect there'll be a bunch more. But by and large, it's a decentralized ecosystem. A lot of the projects that are being funded are decentralized and they exit as tokens. And because of this lopsided nature, exits are becoming very, very challenging. And you could argue that, hey, venture capital, maybe the 75 billion that was raised was all front-end loaded, like in 2017 to 2020. The math is different, like only about 7.5 billion was raised between 17 and 2020. Bulk of the money has been raised since. And you're kind of seeing that already. In the sense that if you look at, I'll give you a classic example. Right now in the liquid markets, an equal weighted index, there is a market vector equal weighted index, it's down 20% on the year. Bitcoin's up 41, 42, same as ETH. So the point I'm trying to make is when people look at crypto, you shouldn't just think about investing in venture or only investing in liquids. I think they go both hand in hand. They are, I think liquid is liquid crypto, and I think given the current setup, these things are cyclical. If you looked at your vintages from 2017 to 2020 in venture, those were amazing markets for venture capitalists because this did not exist. Like the size of the liquid markets was significantly larger, so there was a great way for VCs to exit. So at this current moment, we feel like, away from Bitcoin, the rest of the market is very nascent, it's very early stage, it represents liquid venture, and kind of like an allocation into liquid strategies makes a ton of sense, given this current setup.
Thank you. I want to jump to John. John, if you could take us in a little bit of a different direction, it'd be helpful if you tell us a little bit about what's happening at Grayscale. And also, though, you have that history from Invesco with the QQQs. You've been in the ETF market forever. And if you could kind of help the audience understand, what is the, potential impact of having ETFs on this ecosystem.
Yeah, and I can build on some of the comments that were just made about kind of the trajectory of the space more broadly. But just by way of introduction, my name is John Hoffman. I'm based here in Chicago, lead our distribution and partnerships effort at Grayscale. I joined Grayscale about 9 months ago after nearly 20 years in TradFi. Most recently running Invesco's ETF business in the Americas. So was able to kind of see the ETF progression over the past 20 years and couldn't help but notice the parallels in crypto as it relates to kind of the early days of ETFs, both just technologies, you know, in many ways, and kind of how these technologies grow and what the adoption looks like. By way of introduction from a Grayscale standpoint, Grayscale is the world's largest crypto-focused investment management firm. You know, we've been in the market for over 10 years. We offer over 20 capabilities today in the US, really across a number of wrappers. So from private placement, really listed private placements, all the way through exchange-traded funds. We do that in active and passive capabilities, and we do that in single token, multi-token, diversified portfolios. So our mission is really about making it simpler, easier, more convenient to access crypto through, you know, future-forward regulated investment vehicles. And we've really done that, you know, through the last decade and really pushed the envelope there. I think a lot of people will say that there would not be Bitcoin ETFs today without some of the work that we did over the past decade. We think we're in the very, very early days of this movement. I think everybody in this room probably feels that. You know, we believe that more is going to happen in the next 3 years in this space than really has happened in the last 15 years. If I look at it from an ETF lens for a moment, you know, being in the weeds on ETFs for a long time, I think this market generally has kind of, as much excitement as there is about the, you know, what ETFs have done here to open up this category, I think it's almost underappreciated for how significant this is going to be. You know, I started on the ETF side. QQQ was a $3 billion fund. It's a $300 billion fund today. We launched a mini version of that under my leadership, and that's a $30 billion fund today. What ETFs do is, again, make it simple, easy, convenient to access this space. But more importantly, if you think of an ETF as a piece of technology, much like any technology, it creates a platform for implementation. So I remember we'd develop products, we'd go out, we'd talk to clients, we had this perfect view of how they were going to use it. And every client we spoke with was using the product in a different capacity and had different implementation purposes. And I think that that's what we're going to see in Bitcoin, in Ethereum, and as the ETF wrapper, you know, continues to open. We look at the market a little bit differently from a capital standpoint. You know, there's $100 trillion of capital here in the U.S. 10 trillion is in kind of the self-directed retail category. High adoption rates there of crypto. The wealth management intermediary segment, which, you know, manages about $35 trillion, is just starting to come online. The institutional segment, it's about a $35 trillion segment as well. Pension foundation endowment starting to come online. And then ex-US, we see a lot of investors come into the US markets to access exchange-traded funds. So it's $60 billion in ETFs in 6 months. That number is just getting started. I left, again, the ETF space because it hit me one day after kind of being in crypto personally for over a decade. This is a technology, it's built by technologists, and this is not a knock on technologists, but I think that there has not been the proper bridge to the people that steward the capital in this country. And so we are, you know, really focused on showing up in a way that they're used to, talking the language that they're used to, and helping them diligence these products in a way that is just getting started. So obviously very optimistic. We think the space is going from 2.5 trillion to 10 trillion relatively quickly. You know, the last couple things I'd say is from a financial professional perspective, you know, I think in a lot of ways, your job is to kind of, you know, make probabilistic decisions about an uncertain future. You don't know what the future has, you can't predict it, but you make decisions today. And yet, most financial professionals have been underallocated, undereducated, and have not participated in this space. That risk, you know, I would say that they've been prudent though, because there's been career risk, reputation risk, regulatory risk, and so they've been prudent in many ways, but they've missed, you know, a 50,000% return in Bitcoin. Having said that, that risk has just inverted, and we are actually literally seeing the inversion of that risk, where advisors, financial professionals are coming to us saying, I think I may have career risk reputation risk if I don't understand this. So I need to understand this technology. And that's the thing that has really flipped, I think, in the last 6 months, is people raising their hand to say, I need to be able to talk about this. No longer can I say, this is vaporware, this is going away, this is a fad. And I think that's a really big turning point in the industry.
That's helpful. That's helpful. Thanks, John. Then Carson, you come in bringing infrastructure to these liquid strategies. Could you give us a little background on Membrane and kind of how, like, what are the problems these liquid strategies face? Because I get it, like the Grayscale offering, right, of that one click in my Wells Fargo account in a wrapper I understand is simple. I also give up that I'm not really participating in some of the idiosyncrasies of the ecosystem, but those idiosyncrasies bring operational security risk and bookkeeping and everything else. So maybe you could kind of fill in how you service those groups.
Yeah, absolutely. So I'm Carson Cook. I'm the founder and CEO of Membrane Labs. At Membrane, we build prime services infrastructure for institutions. So we're definitely seeing sort of the structural challenges that desks take in deploying these liquidity strategies. I think building on what was said, I'm going to talk a little bit about how liquid strategies are going to take for granted a lot of just being able to go into the markets coming from traditional finance versus in crypto. In crypto, the capital is actually an active participant. So if I'm in the traditional market, I'm used to just parking my funds at a clearinghouse or at my broker, and I can just access market. If you're in crypto, you've got DeFi, you've got CeFi or centralized exchanges, and you've got OTC. If you're in DeFi, you're dealing with smart contracts. If you're in CeFi, you're basically custodying your funds often at the exchange, at least in the model that we've been following up until now. And if you're doing OTC, the tools of OTC are basically Telegram chats and wallets. Terrifying, but it's true, and all the groups do it. So really what we focused on within Membrane is we've built a netting and settlement layer on top of which we've built full collateral management that plugs into our lend-borrow capabilities, as well as cross-margining into derivatives and delayed spot OTC trades. And we're really trying to make OTC trading accessible to liquid traders. Right now, kind of up until now, you generally are going to be on a centralized exchange. I'll put DeFi to the side for a minute. Be on a centralized exchange, and you'll take that call it FTX risk of being at that location in order to sort of operate. Everything's pre-funded spot generally. And so within Membrane, we're trying to move people away from just doing Telegram chats so that you can actually have the infrastructure that allows you to select where and how you custody. MPC, wallets, custodians, and then link that into your array of counterparties, your different desks, so that not only can you enter into spot trades in a secure and manageable way that can plug into liquid strategies, but also you can access margin and other things that really isn't available pre-Membrane.
Okay, I have two questions. I'm going to start with John. We talked a little bit about kind of, I don't know if beta is the right word, but the network effects and how and where they will attribute. Can you kind of talk a little bit about, you know, how you guys are thinking about it in products? Like, so when we look at the startups and the, you know, applications and the early stage investing, that's one way to capture alpha. That's one alpha. But then you were talking about the alpha that comes with some of the bigger networks.
Yeah, and I would just elaborate on, you know, within our offering, we're doing things kind of on the far end of the spectrum of private placement, things like, we just launched an AI fund that holds TAO. We have a TAO direct private placement. You know, so things that are kind of out there on the further end of the curve. And, you know, obviously smaller networks, earlier stage adoption, and then flip to the other side of that, things like Bitcoin, you know, that are well understood in large networks. I think that what we're going to see now is what I call, again, now that, you know, the proverbial pipes have been connected to these pools of capital, making it simple, easy, and convenient to access. We're just starting to turn on, you know, again, what I call kind of the surround sound of the ecosystem. And, you know, we're going to start to see, now that you have ETFs, and that they're essentially capital markets vehicles, as ETFs mature, and as adoption increases, and as application and implementation changes from kind of user to user, it accretes value to the end investor because it becomes incredibly efficient. So what we haven't even started to see yet, even at $60 billion in 6 months on ETFs, is the ability to lend ETFs as an example, to lend the underlying crypto as an example. Options will become listed on these things. Structured products will be created. You'll be able to hypothecate, the underlying securities. All of that just creates more and more liquidity around that. You'll trade futures against ETFs. There's, structured notes against linked to ETFs. All of that is the progression that will happen here. And none of that has really started, but now the foundation is in to build that. And so, that's what we're going to start to see. I believe, and we believe at Grayscale, that we just launched a Ethereum fund last Tuesday, the world's lowest fee Ethereum fund. The network effects that will play out from investors accessing Ethereum. This is going to continue to play out. So keep pulling that forward. You're going to see more and more token make its way into the ETF wrapper, and you're going to see more and more permutations and iterations of that. And you're going to see increased understanding and education of this technology, which is going to drive capital, to the liquid portion, and then it's going to go downstream. People start with Bitcoin. We all know that. They go to Ethereum. After they've done that, they call us and say, hey, I see you just launched an AI fund. What's decentralized AI? And that's the next conversation. And so I think, again, this is just a technology. It's a piece of code, I think that was said earlier. ETFs are just a technology for delivering investment returns. And we now have linked these two technologies, two of the most significant technological innovations really of our generation, at least in the financial sector. And that's going to open all of this up a lot more.
Excellent. Okay, there's another slide of Srini's I wanted to bring up. It was, keep going. Next, is there another one after this? I think they pulled in the wrong one. Well, maybe you can do it first, Srini. We say this bucket of active strategies, but if you could kind of work through the taxonomy, the kind of what are those different categories and how they relate to each other, and then I'm going to I have a question for Carson.
Yeah, sure. So as I mentioned, we have two share classes. One of them is market neutral, and I suspect you wanted to talk about that. But if I may take like 2 minutes, I'll just talk about the liquid token strategy. So I think the way I look at this liquid market, so there is Bitcoin, where it has found a use case. The use case is, I'm a big believer in bottoms up, kind of like the way most of the early stage venture investors are. Bitcoin is where it is because there is a use case for it, and it's become this de facto store of value, a very efficient store of value. And then when you look at the rest of the ecosystem, it's really more the technology stack. It's basically smart contracts. It's the ability to move assets around at the speed of light. And those things are yet coming up. And the underlying narratives change by the quarter. And so I think while Bitcoin is really set up well for an index product simply because it's got a use case, I'm not convinced that the rest of the ecosystem somehow is going to be unchanged for the next 3 quarters, let alone the next 5 years. So as such, the reason we feel like a fund-of-fund makes a lot of sense is there are more than 12,000 tokens out there. There are more coming in as VCs exit. There is a lot of relative value there. And we feel like the only way you can access the technology side of it, which I think Ethereum, smart contracts, Web3, the ability to move, redefine the way payments and settlements are done, that's going to be the major value driver in this ecosystem. It will dwarf the value that Bitcoin has. It will take some time. And we feel like the right way to invest there is really through a professional lens, guys who are spending 24 hours a day looking at network effects, looking at what's happening with network traffic, tokenomics, security, decentralization. And we feel like because there are so many projects out there, because things are moving so rapidly, a portfolio of managers makes the most sense to us, because a good portfolio manager typically has like research done on 10 to 15 projects. And then you put together a portfolio of managers together like that, and it becomes a really powerful way to kind of access the ecosystem from the long side. On the market neutral side, like, you know, people don't really talk about the market neutral. Like,
What I mean is, like, try to, like, what are the strategies you're doing?
it's incredible.
Give us some
So
examples.
so I'll give you a couple of examples. It's a very nascent asset class, so it's got tons of like idiosyncrasies, mispricing. So broadly, we have 4 sub-strategies that we kind of have put together in the market neutral side. One is algorithmic market making. So if you're an algorithmic market maker, the exchanges actually pay you money to make markets. You're simultaneously making markets on 10 to 15 exchanges. You know your order book. And there is, not only are you getting funded by the, you know, you're getting a kickback from the exchanges, you're also making money making algorithmic markets, right? And a couple of managers that we have there, they're basically annualizing roughly around 25 to 30% a year. The other one,
Is this outside Bitcoin, Ethereum?
this is about 250 coins.
250 coins. So it's
250
really
coins.
providing liquidity to the
ecosystem.
To the ecosystem at
Correct.
the smaller points.
So it's providing liquidity to the ecosystem, it's providing price discovery, so all the things that you expect from a market maker. The other kind of low-hanging fruit is this concept of cash and carry, which is you have futures trading at like a massive premium to spot. So there is like, as there is demand for Bitcoin on a leveraged basis, you have futures trading at a massive premium. And at times of kind of, you know, I hate to use the word froth, but there is some froth, some time to time. Times of froth, the difference basically is about 30% on an annualized basis with very little risk. You can go to one exchange, margin the
So
two.
the classic cash and carry basis trade.
Cash and carry basis trades.
Buy the spot, sell the futures.
Exactly.
But these futures are perpetual.
So if it's Bitcoin, you know, you can do it on the CME.
Yeah.
But yeah, most of them.
Oh, that's
are,
right. So see me your calendar and the
right. But
and the
majority
DEX
of the
ones are
250
perpetual.
coins are like, you know, the perpetual futures. They're only done on exchanges that are abroad. You're not allowed to do that in the States. So our managers are, you know, located in France and UK. The third strategy is what old school relative value. So think of these guys as buying Bitcoin, selling MicroStrategy, or buying Bitcoin and, you know, doing something against the miners. They made a killing with, thanks to you guys, on the Grayscale and Bitcoin Trust. Like, these things were trading at massive discounts. So you could effectively own the Grayscale Trust, sell Bitcoin, and, you know, you annualize about 50%.
We did that trade because it's like you look at this, like the Bitcoin's really there, you know.
Correct.
The Bitcoin is actually there.
And now you have those same guys effectively providing the market with, basically making sure that there is no slippage between the ETF and the underlying. So there's a whole bunch of like ETF arbitrageurs that are trading Bitcoin or ETH versus the corresponding ETF. And lastly, the fourth strategy is collateralized lending. You effectively, you go into liquidity pools, you're 200% over collateralized, and you're lending to various counterparties on a secured basis, making out whatever, 20% or so. So last thing I'll say is, the fund has only been around for 14 months, but the market neutral strategy has annualized about 20% with a 3.6 Sharp. So that's the power of being in a nascent market at the early stages. And it doesn't, when we talk about
because
crypto,
there's so many more mispricings, there's so much more inefficiency.
Correct.
That these strategies that you would do in TradFi, where you have to lever them up and you have to have cheap financing and everything to do it, in crypto, there's still a lot of room.
You're shooting fish in a barrel.
All right, now I'm going to push to Carson. So Carson, what's the risk in that? Because moving tokens around and lending and DeFi, what's the risk and how do you help?
Well, I think we all saw the risk cascade out over the last couple of years here as Three Arrows went under and Terra Luna, and then it basically cascaded through the entire street. So we've really built Membrane from the ground up to make sure that we address those risks. So if you look at the current lending state, there's so many people looking to borrow for those various strategies that Srini was just sharing. But there's not a lot of lenders out there. There's only one or two that were like the lenders that were the big names and that existed pre-FTX and Terra Luna and Three Arrows collapsed. The reason everything cascaded through, we've seen everyone's lending activity. Everyone was doing things in a spreadsheet, and they had an analyst that was maybe occasionally updating, I'm not lying. So across Bitcoin, ETH, and then you can imagine the alts if they were lending against those. They were either they were doing uncollateralized lending, so things like signed Kyle Davies, for example, in the past was like, trust me, I have $8 billion in whatever, and they were using that in order to underwrite these loans. They were either not taking any collateral, or if they were collateralizing things, they just weren't updating, the spreadsheets weren't updating the LTVs in real time as price change, so you can imagine how messy that is when you're not getting any additional margin calls as you go. So the whole street got wiped out. And really you can think, one of the biggest sort of observations I have about the space is you have this like space age settlement technology. That's what we think at Membrane of like the different blockchains. As you said, it becomes interesting. Blockchain comes into play once you have the token in the wild, right? And Bitcoin's very established, things like that. Ethereum, we have all these different tokens, Solana, et cetera. But they're really just settlement rails. All of the other things that happen to the actual markets and all of the financial instruments that you want to build around it, it's like in the Stone Age versus traditional finance. Traditional finance, you may have a lot of institutions and a lot of people that are in there that can fail, but at least they've been around now for decades and they figured out how
risk
to do
committees and credit committees and
Correct.
business committees. And, yeah, I've been on them.
A lot of times too much bloat, and we do want to kind of reduce those middlemen. But in crypto, there's basically, you have kind of the worst of both worlds where you don't have those things. You still have people in, but you might only have someone just out of college and he's the only one looking at, he or she's the only one looking at a spreadsheet updating these things. So within kind of getting to how we then solve the problem is we really use what I call a hi-fi approach. We're kind of a hybrid finance approach between DeFi and CeFi. We allow desks, lending desks, trading desks, ECNs, exchanges, to choose where and how they custody, or their clients where and how they custody, so they can independently select, hey, what MPC, wallet, self-custody, qualified custodian do we want to use? Then they can actually share in a portal for their clients. They can see the collateral in real time. They can do all the margin management associated with derivatives trading, with lending. They don't have to have spreadsheets anymore where they're updating LTVs in real time. Margin calls happen automatically, and everyone is literally and figuratively on the same page. So the goal here is just increase transparency and provide sort of workflow management that allows lending to function as it should, so that when someone goes under, which they will again, hopefully it doesn't cascade the whole street,
Right.
now actually we can survive.
So you can support Srini's strategies.
Okay. Just come on. I'll just say, I think FTX was probably the best thing that happened to this ecosystem. There were tons of bad practices, bad actors. What I find so interesting about this ecosystem is it's supposed to be trustless, it's supposed to be decentralized, yet our dependence on centralized institutions and agencies in this ecosystem is outrageous. And that's where all the failures have occurred. And effectively what FTX did was, brought into fore. Your typical crypto guy basically looks at somebody like me, oh, it's a TradFi fart. What does he know?
You pointed at me when you said
No.
Yeah,
I didn't say that. But yet, I think there was lack of understanding of simple things like counterparty risk, margining,
I think you're right. I think that, as I even think of the ETFs, and your custody practices are probably better than they ever would be post FTX, right?
Yes.
I mean, it's certainly a question that we weren't getting pre-FTX that becomes a question, in every diligence meeting. I mean, I think, again, the things that we take for granted in TradFi, again, when I was set on the TradFi side of the world, I don't think anybody in my 20 years have ever asked me if we use Bank of New York or State Street or how is the assets custodied. It was just assumed that it was safe. There was very little discussion there. Obviously in crypto, that's one of the first questions we get in the diligence process is explain to me custody, and it's a pretty deep, part of the diligence process. So I do think in time, and I'm hopeful that in time, that does become a non-differentiating characteristic of crypto. And we're past the conversation of where is the coin held, and more focused on how are the strategies managed. But we're very much in the still in the period of kind of.
All right, I got all my questions answered. We only have a couple minutes left. I want to see, we have any hands? Does anybody have questions for these guys? Emil, we got a microphone for him?
I can speak loud.
I know you can.
So I think that in active trading, the biggest risk probably right now is counterparty risk. Clearloop has done something, but what do you think is going to overcome the prime counterparty risk, the exchange counterparty risk, all these things that could make your money disappear overnight?
One word, diversification. That's why we run a fund of funds. So the way we look at managers, we never pick a manager unless, so our goal is you have less than 15% exposure to any one fund, any one exchange or counterparty. And then if you diversify that amongst like 8 managers, you're kind of like reducing your counterparty risk that way. So there is no way getting around counterparty risk. It'll remain. It happens. Exchanges happen to be centralized agencies that are run by human beings, and it's a risk that needs to be quantified and managed. And it's not just a function of it's not a function of just a crypto market. Lehman Brothers has failed. There's a bunch of traditional, financial institutions that have failed. And if you go outside of the US, we continue to talk about crypto in the context of US, it's a global market. So to kind of answer your question, the easiest way to kind of get over that risk is by diversifying across various exchanges and across various managers.
And I'll just add one thing to that. I agree on the diversification, and I think by extension, sort of uncoupling or unbundling of services. So if you take a look at FTX and how most of the exchanges work today, they're not only the exchange, they're also in the case of FTX, the market maker, the clearinghouse, the custodian, the settlement, everything. So it was such an opportunity for what happened there, and you're seeing that across space. I think now people are smarter to that, so if you can kind of unbundle those things, then there's a greater opportunity to diversify where you can select these things independently. That's one of the things we're focused on.
Okay, great. I'm just noticing the time, and we should probably move along. Was there any other question? I don't want to... You had one, Vlad? Let's do that after. All right.
I think that one just really quickly.
Go right ahead.
So look, I think management fees in ETFs tend to be, especially in kind of fungible portions of the market where there's not a high level of differentiation, have significant compression. We're excited that we recently launched the lowest fee Bitcoin ETF and the lowest fee Ethereum fund in the world.
Yeah.
And we're able to kind of augment that with legacy structures as well. So is there going to be fee compression as more and more users come into the space? Yes. That's going to accrete value to investors ultimately. To sit here today and think you could get exposure to Bitcoin in your brokerage account for 15 basis points,
it's crazy.
I think it's a tremendous step forward from where we were, in any previous cycle. So we're going to see fee compression in the liquid segment of the market.
I'll just add, your question was around liquid managers. So up until the ETF came about, liquid managers could charge 2 and 20 and effectively return Bitcoin type of returns. And I think one of the things that will happen as a result of easy access to Bitcoin and Ethereum is, my suspicion is down the line there's going to be a hurdle rate, which will be either a Bitcoin or an ETH type of a hurdle rate after which you can pay the performance fee. Because the current model doesn't work. Most managers are returning Bitcoin on a gross basis and then they're charging 2 and 20. It makes no sense. So,
Cool.
Fee compression's coming.
Everybody, please help me give you a round of applause for these guys.